Why your student debt is designed to never end. The call timer on her phone read 2 hours and 57 minutes. Her lunch break had ended ages ago. Still, she stayed on hold, one ear tuned to the repetitive music while rereading an email that made her stomach drop. The payment she swore she made last month gone. Her credit score had tanked overnight. When someone finally answered, the rep started reading the script before she could even explain. Please hold while I review your account. Another click, another song, another pause. That's how millions of people meet the student loan system. Not through policies or politicians, but through hold music and panic. You do everything right, pay on time, keep records, follow the instructions. And then 1 month everything breaks, and somehow it's your fault. You feel your stomach sink, anger bubbling under confusion as the rep shifts the blame. You're told an account number changed, or a payment posted to another loan. You're told to check back in 6 weeks, and you hang up wondering if you're losing your grip or if the system's designed to make you feel that way. But this story isn't just about one borrower and one mistake. It's about how the entire student loan servicing industry, the companies that manage these accounts for the government, turned confusion into a business model. These companies are supposed to make repayment simple. Instead, they've built a labyrinth, transfers between servicers, cryptic statements, disappearing records. They don't own your loan. They just control how you experience it. And that's where the trap begins. Right now, Americans owe over $1.6 trillion in student debt, spread across more than 40 million borrowers. But the real machinery keeping those balances alive isn't in the Department of Education or Congress. It's inside a cluster of private contractors that process payments and handle questions for the government. Their systems decide how your money applies. Their errors decide whether you qualify for forgiveness. When the system breaks, borrowers don't just lose patience, they lose years. It sounds dramatic, but ask anyone who's called their servicer. Hours on hold, conflicting answers, documents lost or misfiled. It's not random chaos, it's normalized. It's the kind of chaos that creates exhaustion so deep you stop questioning what's happening. The truth is that confusion pays. Every delay stretches out repayment timelines. Every miscounted payment keeps the loan active, and every active loan means continued servicing fees. And every exhausted borrower who gives up on fighting back becomes proof that the system's psychological design works. And here's the big question. If you're paying every month, why does your balance barely move? That's what this story is going to uncover. We'll peel back the layers of contracts, incentives, and silent bureaucracy running behind those automated phone menus. We'll look at how a system built to manage debt quietly learned how to sustain it. For decades, people thought the student debt problem was about high tuition, the loans themselves. But what really keeps borrowers stuck isn't just the borrowing, it's the servicing. The system that's supposed to make debt manageable instead makes it endless. We're going to rewind to where it all began. The moment the federal government handed over management of student loans to private companies. It was supposed to make everything more efficient. Instead, it built something no borrower can easily escape. If you've ever wondered why, after years of paying, you seem no closer to freedom, if you've ever looked at your account and thought it doesn't add up, you're not imagining things. The system was never meant to make it easy. Stay with me. By the end of this story, you won't just know what went wrong. You'll see how the design itself ensures your student loan is a product that never really ends. The birth of the servicing maze. To understand how today's nightmare took hold, we need to go back to the 199s, when federal student loans made a quiet but crucial shift. Back then, the government didn't yet have its massive digital systems or call centers. It relied instead on a patchwork of banks and guarantee agencies to issue and collect student loans. Millions of young borrowers paid their local bank, not a faceless contractor. Then came a political buzzword that changed everything: efficiency. The Department of Education wanted to streamline operations and reduce costs. The solution seemed simple: outsource loan management to private companies that could handle the volume more efficiently. These companies would collect payments, track records, communicate with borrowers, and manage repayment plans. In theory, the government would oversee the rules while the contractors handled logistics. In practice, the handoff created a middle layer so thick that even the government would struggle to see through it. One of the first big players was Sallie Mae, originally a government-sponsored enterprise designed to support student lending. By the 199s, Sallie Mae had privatized and wanted a bigger slice of the action. It positioned itself not just as a lender, but as a service provider, a company that could manage loans on behalf of the government. When the department opened the door, Sallie Mae stepped through with a sophisticated pitch. Let private industry handle the paperwork. Borrowers didn't realize much had changed. They still got bills. Payments still went through familiar-looking portals. But behind the scenes, Sallie Mae had started building a massive infrastructure optimized not for simplicity, but for scalability. The goal wasn't personal service, it was volume. Millions of accounts, each treated as a product line. As education costs soared through the late 199s and early 200s, federal lending exploded. Suddenly, the government was responsible for hundreds of billions in outstanding student debt. Instead of expanding its own administrative capacity, it doubled down on outsourcing. New servicers entered the picture: state agencies, private firms, and subsidiaries of big financial institutions. Competition became the excuse for reform. The department promised that by holding servicers accountable through contracts, borrowers would get better service. What really emerged was the contract economy of student loans. Servicers were now paid not based on how much debt they managed, but how many accounts they handled. A flat fee per borrower. Whether a loan was $5,000 or $150,000 didn't matter. Each was just another entry in a digital queue. Every borrower became a unit on a balance sheet. On paper, this made sense. Fixed fees meant predictable costs for the government. But it turned repayment into a game of throughput, not problem solving. To a servicer, the fastest way to resolve a call is to end it. The easiest way to handle a complex repayment question is to offer forbearance, a temporary pause, rather than walk the borrower through confusing income-driven repayment forms. By the early 200s, complaints about lost paperwork and miscounted payments began surfacing. Borrowers couldn't get straight answers about their balances. Federal reporting systems couldn't reconcile data between lenders and servicers, yet the contracts kept growing. Each time a servicer made errors, the fix wasn't to build oversight. The fix was to bring in more servicers to compete. The maze got bigger. Meanwhile, Sallie Mae split off its servicing arm and renamed it Navient in 2014, a move meant to signal modernization. But structurally, nothing changed. It was still a descendant of the same outsourcing culture that valued scale over accuracy. Navient inherited the largest federal loan portfolio in history and quickly became the face borrowers associated with endless hold times and contradictory information. For millions of people, their student loan journey started right after graduation with a letter saying, "Your loan will now be serviced by insert name." That phrase, so ordinary, marked entry into one of the most confusing bureaucratic networks in modern finance. If you changed jobs, moved cities, or even changed email addresses, your connection to that system could fracture. Miss one communication and consequences snowballed. Payments misapplied, forgiveness years erased, interest capitalized quietly in the background. The first generation of borrowers under this new system felt that something wasn't right. They noticed their balance didn't shrink, even while paying faithfully. But few had the knowledge or the time to decode the rules. They assumed mistakes were their fault. After all, servicers presented themselves as neutral administrators. They rarely admitted error. For every borrower who pushed back, thousands just accepted the confusion. Many of those early borrowers were first-generation college graduates. They believed education was the ticket to stability. What they didn't realize was that their loan wasn't really owned by their lender anymore. It was managed by a contractor incentivized to keep them paying, not progressing. The rules about deferment, forgiveness, interest accrual, all ran through systems designed with minimal transparency. By the late 200s, reports began to emerge from state attorneys general and consumer advocates documenting bizarre inconsistencies. Identical borrowers in the same program showing vastly different payment histories. The labyrinth wasn't an accident. It was the structural outcome of delegating responsibility across corporations whose primary accountability was to their contract, not the people calling for help. The result wasn't just inefficiency, it was a new kind of dependency. Servicers became indispensable to government operations. The Department of Education couldn't suddenly take servicing in-house without disrupting millions of loans. Complexity had become self-sustaining. The harder it was to track where problems originated, the safer the servicers became. What started as outsourcing had evolved into an opaque financial ecosystem running parallel to the government's own operations. Borrowers were told their loans were federal, but every experience of repayment was filtered through private systems, private call centers, and private incentives. And as the balances grew, so did the influence of those managing them. Sallie Mae had turned into Navient, new competitors entered, and the servicing maze cemented itself as an unavoidable feature of student debt. This was the invisible moment when control slipped away. The government technically owned the loans, but it no longer managed the relationship. Borrowers did what they were told, filed, paid, recertified, but the people on the other end of the line worked for companies with different priorities. That disconnect between who owns the debt and who controls the experience is the foundation of the modern student loan trap. In the next chapter, that trap takes shape in full view. Because when Navient's empire began to fall, what spilled out exposed that this wasn't just one company's mismanagement, it was the entire business model laid bare. The downfall didn't just confirm borrower suspicions. It validated years of doubt, frustration, and quiet emotional burnout that millions had already internalized as personal failure. The Navient empire and its fall. When Navient spun off from Sallie Mae in 2014, it didn't leave behind controversy, it inherited it. Overnight, this newly branded company became the heavyweight of the student loan servicing world. More than 12 million borrowers under its care, managing over $300 billion in loans. On paper, Navient was supposed to bring innovation and transparency to a system full of old frustrations. In practice, it replicated every flaw and scaled them to industrial size. For borrowers, the transition looked routine. One day they had Sallie Mae statements, the next, letters from Navient. Nothing about the note itself changed. Interest rates, balances, payment dates all the same. But what did change was the back-end system that tracked their payments, applied them across loans, and communicated with credit bureaus. Those were the levers that borrowers couldn't see, and it was in those shadows that Navient's problems began. Customer service scripts grew longer, call times shorter. Representatives were trained to move borrowers through the conversation cycle quickly. Acknowledge, deflect, offer forbearance, close. Forbearance, pausing payments temporarily, was the cheapest, fastest way to get a borrower off the line. It didn't require detailed income documentation or the maze of forms needed for income-driven repayment programs. It was simple for the company. But every time a borrower accepted forbearance, the unpaid interest piled up, ballooning the total cost of the loan. The Consumer Financial Protection Bureau began receiving thousands of complaints. Borrowers said they tried to enroll in more affordable income-based plans, but were instead guided to short-term pauses that left them worse off. Others discovered payments applied incorrectly, sometimes split across multiple loans in a way that triggered late fees. Some said that supposed credit-building programs after default were exaggerated or misrepresented. By 2017, the CFPB filed a sweeping lawsuit accusing Navient of unfair, deceptive, and abusive practices against millions of borrowers. Navient denied wrongdoing, pledging to vigorously defend itself. Yet the evidence painted a pattern too consistent to be ignored. Internal communications, according to investigators, revealed a company culture optimized around efficiency metrics, not borrower success. Representatives were graded on call times and closure rates. Helping someone enroll in income-driven repayment might take 20 minutes. Granting forbearance took less than 3. The data told management that fast calls were good calls. The financial outcome, debt growing instead of shrinking, was quietly profitable. Meanwhile, borrowers experienced decades-long consequences. Many who had been working toward public service loan forgiveness discovered their counted payments were wrong. Months, sometimes years, vanished from their progress records. Some found that payments had been applied to the wrong loan groups altogether, resetting schedules and erasing headway they thought they'd made. The ripple effects weren't abstract. They determined who could buy a home, who could start a family, who could retire someday. State attorneys general joined the fray, alleging similar misconduct. Investigations found systematic steering into forbearance instead of informing borrowers about better long-term options. Navient's misapplied payments led to unnecessary late fees, damaged credit, and interest capitalization. Millions of borrowers spent years thinking they were on track, only to find out later that they'd been standing still. Then, in 2021, Navient made moves that looked like a retreat wrapped in strategy. It transferred its entire federal loan portfolio to another contractor, Maximus, later rebranded as Advantage. At the time, Navient framed this as an operational handoff, clean, practical, efficiency-driven. But quietly, the CFPB's legal pressure loomed. By early 2024, the agency and more than 30 state attorneys general reached a historic settlement. Navient would pay $120 million in penalties and restitution, and more importantly, it would be permanently banned from servicing federal student loans. The ban didn't admit guilt, but it confirmed what borrowers already knew from experience. That mistakes weren't random, they were business decisions. Navient exited the federal stage, leaving millions of loans to be handled by others. Yet the borrowers didn't feel relief. Their loans were simply transferred again, and many saw the same issues repeat under different names. For regulators, the Navient settlement represented a landmark victory, proof that abusive servicing wouldn't go unchecked. The CFPB called it accountability long overdue. But for borrowers, the practical reality was anticlimactic. The new servicers inherited the same databases, the same opaque systems, and in many cases, the same problems. Lost paperwork, contradictory payment histories, unexplained interest. The names changed, the structures didn't. Behind the fanfare of the ban lay a sobering truth. The systemic incentives remained untouched. Servicers, regardless of their logo, still earned a flat fee per borrower. They still faced low compensation for complex cases and higher rewards for accounts in simple, automated status. The fall of Navient didn't dismantle the structure. It merely demonstrated that any company working within it could slide toward the same tactics. Borrowers affected by Navient's actions were promised restitution, a tiny credit here, a few $100s there. For some, that covered barely 1 month's payment. Others never saw relief because their accounts had long since been transferred or sold. The headlines declared victory, but the scars in borrower records, those miscounted payments and distorted histories, rippled across the system, affecting eligibility for forgiveness programs even years later. Inside Navient, the aftermath sparked internal change. The company's CEO stepped down. Its board promised to pivot toward new business. They meant private loans, debt collection contracts, and financial services beyond the federal system. The brand survived, but its role in student loans ended the way many borrowers' stories had, with silence on hold lines, confusion in the details, and a quiet exit. The fall of Navient stands as a revealing chapter in the broader student debt story. It showed that even when caught, punished, and pushed out, a servicer could essentially hand off its borrowers and walk away clean. The damage, meanwhile, lingered on every borrower's account. It wasn't one corrupt operator bringing chaos. It was the economic logic built into the contracts themselves. If you zoom out, the collapse looks less like justice served and more like a reset button. One bad actor gone, dozens of nearly identical ones remaining. The CFPB ban sent a signal, sure, but also a warning. The true machinery behind student loan servicing is much bigger than any single company. It's a web of incentives, contracts, and political approvals that keeps replacement parts ready whenever one fails. Navient fell, but the system didn't tremble. The same logic kept running, uninterrupted. Every other servicer watched, adjusted language in training manuals, and continued business. Borrowers noticed a new name on their statements and hoped things might finally get better. Instead, they found the same phone trees, the same errors, and the same sense that maybe the problem wasn't who answered the call. It was the system itself. The incentive problem, how servicers get paid. On paper, the student loan servicer's job seems straightforward. Collect payments, keep records up to date, and help borrowers stay on track. In reality, it's a business built on contracts, formulas, and performance metrics that most borrowers never see, and almost all misunderstand. The core of the problem isn't corruption in secret emails or executives plotting to ruin graduates' lives. It's the incentives. The way servicers get paid shapes how they behave, what they prioritize, and how your loan sits on their books for years longer than it should. Servicers don't make money when you pay off your loan. They make money when you have a loan to service. Their compensation comes from the Department of Education, not from you directly. The government pays them a flat monthly fee for each loan account they manage. It doesn't matter if the loan is $50,000 or $15,000. It's the same fee. That alone flips the logic upside down. Servicers earn more by having more accounts under management, not by helping those accounts disappear. Under the 2024 contracts, for example, a servicer earns a few dollars per loan per month, enough to total a few $100s per borrower over a decade. Multiply that by millions of loans, and you get a billion-dollar operation. But the payment varies by status. A borrower whose current generates steady income. A borrower who falls deeply delinquent generates almost nothing. So at first glance, the incentive should be to keep people current. Yet servicing an active, paying borrower takes time, training, and consistent follow-up. Forbearance, in contrast, is effortless. Forbearance pauses payments without fixing anything. When you call about struggling with payments, the agent sees two buttons: forbearance or income-driven repayment. The second option requires paperwork, income verification, multiple system entries, and follow-up calls. The first just requires one click and a script to read. You can guess which one's faster when a call time monitor is running in the corner of the screen. That's the hidden math behind so many temporary solutions. Each borrower moved into forbearance is one less complicated file in the queue. Sure, interest still keeps adding up, but that problem belongs to you, not them. For the servicer, that borrower stays on the books as an active account. The monthly contract fee keeps flowing. It's a short-term when disguised as customer service. Meanwhile, if you try to switch into an income-driven repayment plan, your case can sit in limbo for months. Forms get misplaced, income data has to sync between IRS and education department systems, and errors bounce back and forth across databases. During all that time, interest may be accruing and late notices trickling out. If the process burns you out enough to stop trying, the servicer doesn't mind. You're still their account, and the clock still runs. Borrowers often wonder why representatives sound rushed or hesitant to offer alternatives. It's because call performance overshadows results. Many servicer contracts include metrics: short average handling time, low call escalation rates, satisfactory survey responses. The agent who solves a complicated problem might score worse than the one who politely ends a call in 3 minutes. Multiply that mentality across thousands of reps, and helpfulness gradually becomes a liability. The 2024 contract reform was supposed to fix this imbalance. New performance incentives offered small bonuses for keeping borrowers enrolled in repayment and reducing delinquency rates. But the margins are thin. The difference between an A-performing servicer and a C, one might be less than a few dollars per borrower per year. For a company with millions of accounts, it's cheaper to meet the minimum standard than to overhaul operations. Even with the new structure, the reward for excellence is small compared to the cost of genuine improvement. Think of it like this: the department pays for compliance, not compassion. Servicers deliver reports, process totals, and tick boxes. As long as the data looks tidy in Washington, bonuses go out on schedule. Whether borrowers are actually closer to forgiveness or just treading water, that's harder to measure, so it rarely enters the equation. The people answering phones aren't villains. They're hourly workers trying to hit targets designed for machines. The deeper issue sits inside the contracts themselves. A system that treats every borrower as equal inventory naturally pushes human problems into automated categories. That's why so many calls end with standardized scripts, why your emails sound pre-written, and why we appreciate your patience is code for we have no financial reason to rush. There's also the penalty structure. When servicers make errors, misapplied payments, lost forms, the fines or clawbacks are often smaller than the savings from cutting corners in the first place. The department can theoretically assign lower performance scores, but transfers between servicers can take months and disrupt millions of accounts. Punishment is bureaucratically messy, so oversight stays light. Servicers understand this and calibrate accordingly. Don't break the law blatantly, just make complexity your armor. Borrowers living through this chaos begin adapting emotionally. They treat loan management as a full-time side job, tracking confirmation numbers, scanning PDFs, saving screenshots, because experience has taught them that proof is the only power they hold. Their paranoia becomes survival. Yet all that vigilance happens inside a framework that incentivizes confusion. Every duplicate form, every missing signature, every resubmit in 30 days, notice drags the relationship forward another month. More time, more fees, more profit, and more emotional fatigue that quietly convinces you being constantly anxious is normal. There's one story that captures the absurdity perfectly. A teacher named Janine called her servicer after getting a letter saying she was past due. She hadn't missed a payment in 7 years. After half an hour, the rep admitted a payment had been applied to the wrong loan group. A technical glitch, easily fixed, they said. But because the correction required manual reversal and reapplication, it would take 60 days to post. During those 60 days, interest would keep compounding. The agent apologized, offered forbearance, and asked if Janine wanted to suspend payments to avoid stress. She reluctantly agreed. 6 months later, her balance was higher than before she called. Multiply that by millions of similar stories, and you see how the system sustains itself. The servicer doesn't have to rob you outright. It just has to keep you suspended between confusion and compliance long enough for the math to do the rest. That in-between space, where you half believe it might be your fault and half know it isn't, is where burnout starts. It's not just money being drained. It's your sense of control dissolving drip by drip. The irony is that servicers publicly advertise their mission as helping borrowers succeed. But under their compensation model, improvement is a cost center. When success means losing an account and confusion means keeping one, the moral conflict becomes a business principle. The incentives don't just shape behavior, they define the boundaries of possibility. Policy tweaks have tried to realign those incentives, but without transparency into how profits actually flow, most reforms end up cosmetic. Officials can demand shorter call times or clearer websites, but as long as the basic payment model remains a flat fee disconnected from borrower outcomes, the maze keeps reconstructing itself. This is why replacing one servicer with another never feels like change. The names on your statements rotate, the incentives underneath stay fixed. The structure itself guarantees that complexity pays, and simplicity doesn't. Before anyone can solve the student debt crisis, they have to face that uncomfortable truth. The system isn't broken by accident. It's functioning exactly as it was designed to. Complexity as a business strategy. Karen thought the hardest part of her student loans would be paying them off. It turned out, the harder part was figuring out how to pay them off. One servicer portal said she had 8 loans. Another listed 10. A third showed 2 balances already paid off, but those same loans still showed interest accruing elsewhere. Every time she called, the rep told her to check a different system. By the 6th call, she started laughing mid-sentence. It was the kind of laugh that only comes from total exhaustion. That's the hidden genius of the system. It overwhelms you into surrender. The complexity isn't a leftover glitch from the early internet era. It's a coordinated feature. The longer you search for clarity, the more the machine hums along. Because in the world of student loan servicing, complexity is profit. The maze starts with the repayment plans themselves. There are dozens standard, graduated, extended, pay-as-you-earn, income-based, revised pay-as-you-earn, and now save. Each plan has different interest rules, different forgiveness timelines, and different qualification paperwork. Some require annual income verification. Others reset automatically if you miss a recertification deadline by even 1 day. These delicate distinctions don't just confuse borrowers. They generate predictable errors the servicer can bill time fixing later. Then there are the loan transfers. You might wake up one morning and get an email saying your loan is moving to a new servicer to improve your experience. What actually happens is that your payment history gets sliced, exported, and re-imported into a separate database. In theory, it's seamless. In practice, payments vanish or dates get scrambled. Months later, you find your record shows a mysterious gap, that just happens to delay your forgiveness timeline by the exact length of the outage. Servicers rarely volunteer this information. They'll say, "We show a system update delay. It shouldn't affect your progress." Only it does. Every inconsistency pushes you a step backward. For the company, there's no cost to letting that confusion persist. They still collect their monthly fee just for managing your loan. Behind the scenes, these transfers carry another advantage. When an account changes hands, the new servicer gets the benefit of the reset clock, a clean start for measuring performance metrics. If a borrower was frustrated before, now they've been reassigned, no longer part of the retention data that might make the previous servicer look bad. The borrower starts over, the company starts over, and the data hides the instability both know is real. The architecture of these systems is so fragmented that accountability dissolves inside it. Ask one servicer to correct a payment misallocation that occurred before the transfer, and they'll say, "You'll need to contact your previous servicer." Call the old one, and they'll say, "We no longer have access to that file." Weeks pass. Each email, each hold queue, Each resubmitted document adds another layer of distance between error and solution. And that's the point. Every added step lowers the likelihood of resolution. Every unresolved issue increases how long you remain an active account. When confusion becomes chronic, borrowers stop trying to fix small mistakes, focusing instead on simply avoiding new ones. For servicers, apathy might be their most reliable revenue stream. There's a dark elegance in how this complexity sustains itself. Imagine a company dashboard showing millions of borrowers in various statuses: current, deferred, forbearance, pending appeal. The chaos is the metric. Regulators see distributed responsibility. Servicers see distributed accountability. No single department can be blamed for the delays because each fragment is technically functioning as written. That bureaucratic smokescreen becomes a moat protecting the company from consequences. Borrowers sometimes wonder why repayment forms look so antiquated, why online portals still resemble websites from 2005. The answer is strategic stagnation. Outdated designs slow down user interactions, nudging more people toward phone calls, which can be routed, recorded, and counted as activity. Every inbound call inflates service metrics, even when it resolves nothing. Modern interfaces would reduce confusion, but reduced confusion would reduce contact, and contact is measurable engagement, another box ticked for federal auditors. Human stories make these abstractions concrete. In Chicago, a nurse named Rena filed her annual income-driven recertification 5 days early. Her portal confirmed receipt. 2 months later, her interest capitalized because the system logged the form 1 day late. She lost 2 years off her forgiveness track. When she appealed, the Department of Education said servicers were responsible. The servicer said the portal followed department protocols. Nobody reversed the error. Data loss, misplaced forms, recalculated timelines. It's death by 1,000 structured inconveniences. For every fix the government mandates, servicers adapt with new workarounds. Automatic forbearances during disputes, extended processing windows for document verification, or ambiguous notifications that obscure deadlines. Confusion stops being an accident. It becomes policy through inertia. There's another layer: internal communication systems that deliberately separate staff who can see certain borrower data from those who can act on it. The rep you reach can view your payment history, but can't actually reassign a payment. That requires a different department you can't contact directly. So the rep opens a ticket, giving you a case number, and ends the call. The ticket may sit in a queue for 45 business days. When you call for an update, you're told the system has no record of your previous conversation. Meanwhile, the clock ticks. Interest accrues. The loan ages gracefully on the company ledger, and the servicer can truthfully claim they're working on resolution. Opacity protects profits in another way. It shields data that could prove patterns of abuse. When policy researchers or journalists request information about error rates or complaint resolutions, servicers cite proprietary systems. The government, dependent on those same systems, often lacks full access itself. It's like trying to audit a casino while relying on the casino's own cameras. In 2023, when the department rolled out the SAVE plan, promising automatic income updates and interest forgiveness for low-balance borrowers, it looked like a real fix. Finally, a simpler way forward. But lawsuits in 2024 and 2025 froze the rollout. Suddenly, millions of borrowers were back in forbearance, trapped in a half-launched program. Implementation chaos became the new normal. Servicers claimed confusion again, this time with legal backing. The old cycle persisted under a new headline. That moment exposed how durable the servant maze really is. Even reforms designed for clarity get swallowed by administrative fog. Because every change introduces fresh procedures, each requiring new codes, new call scripts, new opportunities for delay. Complexity regenerates faster than policy can simplify it. For borrowers, each year feels like starting over. You gather documents, reapply, reconcile balances that keep mutating. For servicers, that endless renewal means steady business. The system's greatest defense isn't denial, it's fatigue. It counts on borrowers losing the will to question the math. Karen eventually paid her loans off, or at least she thinks she did. The final statement showed a small residual balance, $23 of unexplained interest. When she called to ask, the rep said it was system lag, but payment was required to close the account. She paid it, grateful just to be done. Somewhere in a server farm, her data still circulates. Another completed account, another metric satisfied, another small proof that within this system, simplicity has no incentive to exist. The Save Plan freeze and the new chaos. When the government unveiled the Save Plan in 2023, it felt like a breakthrough, a new income-driven repayment program that would finally make the system fair. Payments would drop to as little as 5% of discretionary income for undergraduate loans. Interest would stop piling up if your payment didn't cover it. And if you owed less than $12,000, your remaining balance could vanish after 10 years. Millions of borrowers were automatically enrolled. For the first time, people saw a glimmer of progress. Social media filled with posts celebrating smaller bills and balance projections that actually declined instead of growing. Servicers sent out glossy emails promising a simpler, smarter repayment future. For borrowers exhausted by bureaucratic hurdles, it sounded like deliverance. A plan called Saving on a Valuable Education. Even the acronym felt optimistic. By spring of 2024, optimism hit a wall. A coalition of Republican-led states, Missouri, Kansas, and others, filed lawsuits claiming the Department of Education had exceeded its authority. They argued that this plan, with its generous forgiveness timeline and deep payment cuts, amounted to an illegal giveaway. Federal courts agreed to hear the case. Then came the injunctions, legal orders freezing implementation. Overnight, the system that promised clarity plunged back into confusion. Servicers scrambled. Borrowers logging into portals found their payment amounts replaced with bold red banners reading, "Account in Forbearance." Some thought it meant delinquency. Others believed their loans were forgiven. Neither was true. What it meant, in bureaucratic terms, was suspension. Payments and interest were paused, but time stopped counting toward forgiveness. Millions who had been inching toward the finish line saw the meter reset to zero progress until further notice. The Department of Education reassured borrowers that this pause would protect them. "No one will be harmed," one spokesperson said. That may have been technically correct. Nobody was being charged new interest, but the harm wasn't financial, it was temporal. Every month trapped in administrative forbearance was a lost month of life under a debt that refused to vanish. Servicers, meanwhile, were caught between conflicting orders. They had to abide by federal court rulings while maintaining accurate records for future account reactivation. Systems built on decades-old code weren't designed for this kind of legal limbo. Some servicers froze entire categories of transactions, locking borrowers out of portals entirely. Customer service lines erupted with calls. Wait times stretched past 3 hours. Representatives read from scripts that explained nothing. "Your plan is pending litigation. Please check back later." Inside these companies, managers treated the chaos as just another operational phase. The injunction might have temporarily halted payments, but the servicing contracts remained active. Servicers still collected their flat monthly fee for each loan they managed, regardless of whether borrowers were paying or not. The system wasn't earning less, it was just earning effortlessly. Borrowers quickly discovered that this pause came with silent penalties. Many were pursuing public service loan forgiveness, which requires 120 qualifying payments. Those months in forbearance didn't count. A nurse in Dallas said she'd worked at a nonprofit hospital since 2012, crediting every payment toward forgiveness. When the Save freeze hit, her tracker stopped. Even though she wasn't paying, because she couldn't, the delay pushed her eligibility date further into the future. She called it purgatory with hold. Music. Policy analysts warned that this wasn't merely a bureaucratic hiccup. The Save Plan had been engineered to replace older programs like Repay entirely. When courts froze Save, they also disrupted thousands of pending applications for income-driven repayment across all programs. For months, borrowers couldn't even switch plans or consolidate loans because the department suspended processing during the injunction. It was a nationwide stalemate, but one where servicers stayed comfortably funded. From an operational standpoint, the timing couldn't have been worse. Interest rates were rising, inflation was squeezing household budgets, and borrowers were returning to repayment after the pandemic moratorium. The Save Plan should have been a gentle on-ramp. Instead, it became a pileup. Letters arrived, then retracted. Payment schedules were recalculated, then frozen again. Each reversal required new coding, new emails, and new training modules for the frontline staff. Costs eventually billed back through contract adjustments. Confusion, once again, converted neatly into revenue. The political battle over Save deepened as appeals dragged through 2025. Advocates called the injunctions a deliberate attempt to sabotage relief. State plaintiffs claimed they were protecting taxpayers. Borrowers stuck in the middle only knew that their supposed lifeline had turned into another administrative storm. The same design flaws, from opaque communication to inconsistent record-keeping, magnified every uncertainty. For people trying to budget, the pause added a cruel psychological twist. They weren't paying, yet their debt still loomed. Should they set aside money, or would they need to reapply later? Email instructions shifted monthly. One borrower said it felt like playing a board game where the rules keep changing, but the banker never stops collecting his cut. Meanwhile, reports surfaced of servicers mishandling the transition into forbearance, posting phantom payments, generating incorrect balances, and sending delinquency warnings to credit bureaus. A few weeks later, those same servicers issued apologies for system errors. None of it restored lost peace of mind or counted back the months erased from forgiveness timelines. Behind closed doors, administrators acknowledged the save freeze as another proof of fragility. Each legal challenge translated into mass technical reconfiguration. Systems designed for steady operations shattered under uncertainty. But each disruption reaffirmed a strange equilibrium. No matter the chaos, servicers still got paid. Complexity shielded revenue streams better than any lobbyist ever could. Borrowers began to share tips online, screenshots, timeline spreadsheets, advice on documenting every interaction. In those communities, anger gave way to resignation. The pattern was clear. Every new reform promised salvation, but once filtered through litigation, bureaucracy, and contractor infrastructure, it became another maze. When the injunction continued into 2025, SAVE stopped being a plan and became a metaphor. It represented every promise that looked like relief, but landed as paperwork. The intention had been noble: make repayment simpler, shorten the path to forgiveness, make education feel like opportunity again. But in a system where servicers thrive on inertia, even good policy can get weaponized by delay. For the government, the lawsuits meant time to defend authority. For politicians, it meant headlines. For servicers, it was a windfall of unearned stability. Payments paused, pressure eased, and the checks from Washington kept arriving on schedule. And so, the newest chapter of the student loan saga looked hauntingly familiar. The borrowers waiting, the servicers billing, the courts debating. Progress suspended in amber, profitable for everyone except the person trying to be debt-free. What started as a plan to save borrowers ended up saving the system built around them. The lawsuit didn't just stall relief. It reinvigorated the machinery of confusion, proving once again that even chaos can be monetized as long as someone calls it compliance. Lobbying for complexity, the industry's political machine. When the public finally turned its anger towards student loan servicers, the industry already had a backup plan: politics. While borrowers wrote complaint letters, servicers wrote legislation. Their trade group, the Student Loan Servicing Alliance, or SLSA, operates quietly from Washington, D.C., representing nearly every major company managing federal and private loans. These are the people who keep the machine running, not with call centers but with lobbyists. Between 2023 and 2024, the student loan servicing industry spent over $3 million lobbying Congress. That may sound small compared to big banks, but in the niche world of education finance, it buys a remarkable amount of silence. Navient, Nelnet, and several state-affiliated servicers funneled hundreds of thousands each into influencing reforms they claimed would simplify repayment. What they really achieved was preserving the complexity that protects their profits. The lobbying pitch always sounds reasonable. The industry says it supports transparency and borrower success. It frames new rules as burdensome red tape that confuses borrowers and increases costs. The irony, of course, is that confusion and costs are the business model. But legislators, especially those far removed from the daily grind of repayment, rarely see the double meaning. Take the Department of Education's Unified Servicing and Data Solution, or USDS. Announced in 2023, it was supposed to revolutionize servicing contracts by tying compensation directly to borrower outcomes. The goal: fewer defaults, smoother access to income-driven plans, better communication. Servicers publicly backed it. Privately, their lobbyists chipped away at the details. By the time contracts were finalized, the outcome-based metrics had thinned into vague performance categories easily gamed with good paperwork. Lobbyists didn't destroy reform, they domesticated it. turning oversight into compliance checklists. So when regulators later announced stronger accountability, they were measuring paperwork accuracy, not borrower well-being. Behind the scenes, SLSA's policy advisors had ensured new standards appeared tough while leaving plenty of gray space to interpret success. In hearings, industry representatives used careful language. They spoke of balancing efficiency with empathy, of avoiding duplicative oversight from state and federal agencies. What they meant was this: let's unify the rules so states can't enforce stricter ones. Because while consumer protection offices in states like Massachusetts, New York, and California started creating their own borrower rights laws, the alliance pushed for federal preemption, a single set of standards weak enough for everyone to follow. Borrower advocates saw through it. A consumer lawyer from Illinois described one lobbying cycle as a masterclass in polite obstruction. Servicers would meet with senators, agree on the importance of reform, then submit technical amendments laden with carve-outs, exceptions for legacy systems, transition accommodations, or data synchronization needs. Each sounded harmless. Together, they made genuine accountability impossible. Inside the SLSA, members frame this differently. They say regulation needs to be harmonized. Their version of harmony means a regulatory floor that doubles as a ceiling. Anything stricter is labeled chaos. And they have the receipts to persuade Congress. When asked about error rates, they produce statistical reports showing 99% accuracy, reports based on self-audits they fund and design. This lobbying doesn't happen in mass rallies or TV ads. It happens in quiet rooms with thick binders and patient smiles. For every borrower sending a desperate email to customer support, there's a lobbyist handing a legislator a pre-written paragraph to insert into a bill. The scale isn't equal. One side writes policy, the other waits on hold. Meanwhile, public frustration drives lawmakers to promise solutions. Each solution means new contracts, new systems, new acronyms, and each new acronym means fresh complexity. SLSA lobbyists learned long ago that reform is not a threat if you can control the footnotes. They don't need to stop change, they just need to design it. Even well-meaning fixes end up feeding the system. Take the data sharing reform between the IRS and the Department of Education. The idea was to autofill income data for repayment plans, reducing paperwork. Servicers supported it eagerly because automation shifts responsibility away from them when errors occur. A mistyped income figure becomes a system mismatch, not a servicing failure. Every simplification carries hidden clauses that reinforce their insulation from blame. The lobbying extends beyond Congress. Servicers engage directly with state officials, pushing model legislation dubbed borrower education bills. The name sounds like empowerment, the content often limits state oversight. The message is consistent. We're already regulated by the Department of Education. It's a clever shield, one layer of accountability used to block all others. The numbers show how effective this has been. Since 2017, federal regulators have issued dozens of press releases touting reform. Yet no large servicer other than Navient has been permanently removed. Oversight exists, but it's negotiated. Each new administration installs fresh priorities, and servicers adjust their language overnight. They study policy memos like survival manuals, swapping keywords in public statements from efficiency to equity to empathy, depending on the season. Internally, SLSA circulates strategy briefs summarizing proposed legislation line by line. One former member described those documents as choose-your-own-loophole guides. Want to delay data reporting? Cite system integration timelines. Need flexibility on complaint response deadlines? Argue borrower satisfaction metrics need reviewing first. This is the quiet art of making accountability scalable, slow enough that outrage fades before enforcement arrives. The Alliance frames all of this as partnership. Its mission statement says it collaborates with policymakers to enhance borrower outcomes through pragmatic reforms. But for the borrowers still navigating conflicting statements, misplaced payments, and endless forms, pragmatism looks a lot like paralysis. There's a reason reforms feel perpetual, but progress feels stillborn. Each round of change regenerates the same patterns: pilot programs, new vendors, transitional glitches, and temporary suspensions. The industry positions itself as the only group qualified to fix the chaos it helped create. Complexity becomes a renewable resource, a justification for its own existence. At town halls, you might hear senators declare the need to streamline repayment. Somewhere nearby, a lobbyist nods in agreement, already drafting a memo explaining why streamlining requires phased implementation over several fiscal years. That delay is profit in disguise. The longer reform takes, the longer contracts remain. State regulators keep pushing back, but their progress often stalls under federal preemption claims. When California enacted stricter loan servicing standards, SLSA petitioned Washington to override them. They argued that inconsistent rules confuse borrowers. The same confusion they once caused now serves as proof of why they should remain in charge. For borrowers, lobbying is invisible until its consequences reach their inbox. Another system update, another new portal, another round of important information about your loan. Each change feels technical, but every line of code echoes a decision made on Capitol Hill. By 2025, the Alliance's influence has turned student loan servicing into what one policy analyst called a perpetual beta test. No system ever reaches stability because instability sustains engagement. The call for simplification is endless because true simplicity would end the contracts that feed the industry. So the political machine keeps spinning, quietly, professionally, profitably. Borrowers keep spinning with it, mistaking complexity for progress. And as long as confusion can be branded as innovation, the system will never run out of work. The borrower's psychological trap. There's a moment every borrower can recall. The night you stare at your loan statement, realize the number hasn't changed in years, and start to wonder if you're bad at math or if the whole thing's rigged. The answer, of course, is both simpler and crueler. The system feeds on that doubt. It convinces you the confusion is your own making. That emotional spiral isn't collateral damage. It's part of the machinery. When people talk about the student debt crisis, they measure it in trillions of dollars and missed payments. What they rarely measure is the mental erosion, the slow acceptance that repayment will never truly end, and that your best coping mechanism is to stop caring. That's not apathy born of laziness. It's learned helplessness, engineered by years of unanswered calls, conflicting instructions, and shifting rules. The message drilled into borrowers over time is clear. You can't win, so don't fight. Borrowers start with optimism. They track every payment, set reminders, color-code spreadsheets. But somewhere between the third servicer change and the fifth lost document, fatigue sets in. You get used to delays. You start believing the problem must be you. Maybe you filled out the wrong form. Maybe you misread the fine print. The system's greatest psychological weapon is plausible self-blame. Jen, a public school teacher, spent 12 years chasing public service loan forgiveness. She kept meticulous files and logged every conversation. When her servicer finally confirmed her paid-ahead status, she thought she was closing in. A year later, she found out that being paid ahead had paused her qualifying payments entirely. She called again, certain there'd been a mistake. The rep thanked her for her service, apologized for the confusion, and told her to restart the count. 12 years reduced to zero because she paid too diligently. Her reaction wasn't anger, it was numb laughter. That numbness is the system's equilibrium. If most borrowers stayed angry, reform would move faster. But people burn out. Between careers, family, and everything else, fighting a shapeless bureaucracy feels unwinnable. So they compartmentalize. They check balances once a year. They assume the math will sort itself out. And in that silence, servicers thrive. Every emotional stage follows a pattern. Frustration, when forms bounce back. Anxiety, when balances swell despite regular payments. Shame, when friends seem debt-free and you feel stuck. Then resignation, that quiet headshake that says, it's just how it works. Servicers have data backing this. Internal complaint analyses show call volumes spike right after regulatory announcements, then drop sharply weeks later. Not because problems vanish, but because people give up. Shame is the glue holding the whole apparatus together. It's cultural conditioning, graduation speeches chanting, invest in yourself. Society frames debt as personal responsibility. So when the system malfunctions, borrowers internalize it as incompetence. That mindset keeps the outrage individualized instead of collective. Each borrower privately embarrassed instead of publicly furious. The industry counts on that isolation. Servicers know borrowers rarely compare notes, so they recycle the same errors, the same scripts, the same, we're looking into it, phrases decades apart. If someone challenges them, they cite procedure. If too many challenge them, they overhaul branding. Confusion becomes the safety valve, releasing pressure before it forms a movement. Psychologists studying debt distress describe it like compression fatigue. The constant microstress, from letters, notifications, and account updates, keeps borrowers in mild anxiety without pushing them into activism. Most cope through avoidance. They stop opening emails until the subject lines blur into white noise. From a technical standpoint, non-response flags as stability. Fewer disputes mean fewer compliance issues. Emotional withdrawal looks great in a quarterly report. The illusion of progress often amplifies the fatigue. The government announces new forgiveness waivers, fresh repayment options, or temporary relief periods. Borrowers feel hopeful again, re-engage, fill out forms, wait for months, then receive a notice saying their application was incomplete. The cycle resets. Hope, confusion, disappointment. Each pass leaves people slightly more exhausted, slightly less likely to try again. There's another cruel twist: the customer service tone itself. Reps speak gently, apologize sincerely, and assure you your patience is appreciated. They sound kind, which makes it harder to stay angry. It diffuses confrontation without solving the issue. It's soft power, compassion as containment strategy. Most callers hang up feeling strangely guilty for having raised their voice. The problem remains, but the emotional tension dissipates exactly where the company wants it to. Over years, borrowers develop strange coping rituals. Some never look at the principal again, focusing only on monthly affordability. Others treat loan portals like haunted houses, visited sparingly and left quickly. A few anthropologize the experience, sharing survival tips online. Always screenshot, never trust confirmation emails. Expect to redo everything twice. Humor becomes armor, memes replace protests. Meanwhile, the psychological toll spills into life decisions. People postpone marriage, homeownership, children, not necessarily because they can't afford them, but because debt breeds uncertainty. How do you imagine a future when your balance feels immortal? Even when logical, those choices erode confidence. Debt stops being a financial issue and turns into identity. Emily, now in her 50s, still pays loans from graduate school. She's long since stopped hoping for an end date. When told about the latest forgiveness program, she shrugs. I've heard that before. To her, the loan feels like a utility bill, just another perpetual cost of existing. This normalization, multiplied by millions, is what economists miss when they talk about manageable payment burdens. The system has managed to make eternal debt feel normal. Regulators occasionally reference borrower confusion as a technical problem to fix with better websites or outreach. But the confusion isn't just data, it's psychological conditioning. A servicer could send perfectly clear instructions tomorrow, and half the recipients wouldn't read them, expecting hidden traps. That's what chronic mistrust looks like. A populace trained not to believe in the possibility of resolution. Even forgiveness itself triggers anxiety. Borrowers who finally qualify for discharge often wait months, terrified the cancellation will reverse at the last second. Some keep making payments just in case. Freedom feels unsafe because instability has become familiar. The relief they imagined for years arrives muted, accompanied by disbelief, and then guilt for even feeling skeptical. It's emotional conditioning at scale. After so many broken promises, trust itself feels dangerous. This erosion of trust is the final stage of control. When a system convinces victims that escape is risky, it doesn't need chains. It just needs habits. Borrowers who no longer believe in progress are easier to administer than those who still hope. They don't flood phone lines or file appeals. They just quietly pay or quietly default. Either way, the machine keeps moving. From the outside, servicers call it borrower compliance. Inside, it's endurance training for powerlessness. Every delayed fix trains you to expect disappointment. Every unacknowledged form teaches patience. And eventually, patience becomes paralysis. The cruelest lie of all is that debt persistence signals irresponsibility. In truth, it signals obedience. Millions have done exactly what they were asked, paid diligently, followed guidance, and remained trapped because the rules keep rearranging mid-game. When obedience still yields punishment, helplessness becomes rational. That's the real legacy of the student loan era. Not just billions in interest, but a generation fluent in quiet despair, conditioned to believe complexity is inevitable and relief unattainable. It's how control survives long after the paperwork ends. Inside people who've stopped expecting the system to change. The legal shield, Why debt can't die. Ask a bankruptcy lawyer what type of debt dies hardest, and they'll tell you it's student loans. Credit card bills vanish after discharge, medical debt falls away. Even gambling losses fade once a judge signs the paperwork. But student loans? They live on. They survive bankruptcy, divorce, moves across states, even death in some cases, clawing against estates for what's owed. The reason isn't moral or mathematical, it's legislative. Over decades, Congress built a wall around this kind of debt, brick by brick, until no ordinary borrower could break through. Half a century ago, student loans were just another form of unsecured credit. If life went sideways, you could wipe the slate clean like any other obligation in bankruptcy court. But in 1976, worried about recent grads escaping payment too easily, lawmakers began tightening exceptions. They claimed it was about preventing abuse of taxpayer funds, though data at the time showed fewer than 1% of borrowers were discharging loans early. Still, the myth stuck. Within a decade, dischargeability vanished unless you could prove undue hardship, a term the law never clearly defined. That phrase became the system's strongest weapon. Courts interpreted undue hardship so narrowly that relief became almost mythical. Judges demanded evidence not just of financial difficulty, but of hopelessness, a lifetime guarantee that things would never improve. Borrowers had to demonstrate total incapacitation, sometimes even permanent disability, before judges considered wiping balances. Everyone else was told to keep paying or enter forbearance. The message: education debt isn't a risk the lender takes, it's a lifelong contract with no escape clause. This legal fortress turned servicers into stewards of immortal revenue. Because loans couldn't die, they never truly left the books. Even borrowers who defaulted remained valuable, an account forever scheduled for collection. Through wage garnishment or tax refund seizures, the Department of Education could claw back money indefinitely. Servicers acting as intermediaries received their fees for managing those accounts year after year. Risk disappeared, profit endured. That's how a loan meant to fund opportunity evolved into a financial life sentence. As the decades passed, Congress reinforced the wall. In 1998, lawmakers removed even the faint hope that time itself could erase student debt. Previously, loans older than 7 years might be discharged. The reform erased that threshold completely. 10 years later, private student loans, once exempt from federal protections, were granted similar immortality. Legislators justified it as protecting the public purse, yet private lenders reaped equal benefits. The result was a two-tier system where every kind of student loan became permanent unless the government explicitly forgave it. For borrowers, the distinction between federal and private vanished in consequences. A federal loan could haunt your paycheck. A private one could chase your cosigner. Parents who guaranteed their kids' loans found themselves sued decades later. Servicers built new departments specializing in long-term recovery, armed with databases tracking addresses, employers, and income levels across generations. If the borrower didn't pay, the system waited for raises, for inheritances, for tax refunds to strike again. Debt didn't age, it simply matured. Meanwhile, forgiveness programs emerged as political patches to soften the cruelty. Public service loan forgiveness, income-driven repayment, teacher cancellation, all designed to offer eventual escape. But these routes ran through the same administrative labyrinth. Yearly certification, precise qualifying payments, flawless documentation. Miss a form, miss a month, and the timeline reset. For every borrower who reached forgiveness, many more simply rotated inside extended repayment cycles. The legal safeguards guaranteeing longevity made sure no mass erasure happened by accident. The psychological effect of legal permanence can't be overstated. Knowing that bankruptcy offers no shelter changes how people behave. They prioritize student loans over medical care, skip rent to avoid default, accept wage garnishment quietly because resistance feels futile. Lenders once feared borrower instability. Now borrowers fear legal retaliation. That imbalance of power isn't incidental. It's a feature of a system where legislation replaced financial prudence. Consider the collection mechanisms embedded in federal law. When a borrower defaults, the government doesn't need a lawsuit to pursue them. Administrative wage garnishment allows automatic deductions, up to 15% of disposable income, without court approval. Tax refunds can be intercepted, Social Security benefits can be withheld. Even disability checks have faced offsets until public protests forced partial reforms. Imagine owing a debt for education you completed 20 years ago and seeing your retirement income docked to pay it off. That's not hypothetical. It happens every year to thousands of seniors. Marjorie, 68, worked as a nurse for 40 years. Her original loan was $9,000. After decades of deferments, interest, and intermittent payments, records show she's paid nearly $20,000 and still owes $6,500. When she tried to challenge the balance in court, her lawyer explained bankruptcy wouldn't help unless she could prove certainty of hopelessness. She laughed, not out of humor, but disbelief. At my age, how much more hopeless can it get? The judge sympathized, then ruled the law offered no flexibility. The garnishment continued. Cases like Marjorie's aren't outliers. They're the logical endpoint of decades of legal amendments engineered to protect the loan system above all else. Servicers operate with the comfort that bankruptcy can't dent their portfolios. Collectors buy defaulted loans for pennies, confident that enforcement mechanisms will yield returns eventually. This certainty fuels the secondary market, a hidden ecosystem where old loans trade hands as long as they still breathe. The longer borrowers struggle, the longer value circulates. Even reform attempts tread carefully around the legal shield. Each administration since the early 200s has promised to simplify repayment and expand forgiveness. But few dare touch bankruptcy restrictions. Politically, it's framed as a moral hazard debate. Lift protections too far, and borrowers might abuse the system. Yet other consumer debts remain freely dischargeable without economic collapse. The persistence of the exception reveals its deeper purpose. The law doesn't just secure repayment, it secures obedience. Bankruptcy's very impossibility shapes public perception. Borrowers believe their debt is sacred, unerasable, therefore personal. They internalize failure when progress stalls because there's literally no institutional off-ramp. The law has turned loans into moral contracts where seeking release feels like cheating. Servicers rarely need to remind you. The statute does it for them. This permanence creates an echo effect across generations. Parents co-sign, children inherit the anxiety, and families quietly reshuffle priorities to avoid potential default. Even after death, estates settle remaining balances. Paperwork certifies that the obligation ends only because the borrower's life has. It's not freedom, it's closure by mortality. Lawmakers occasionally propose allowing bankruptcy discharge after a certain period, say 10 years of good faith payments, but the lobbying resistance is fierce. Industry groups warn of catastrophic losses, ignoring that the federal government owns most of the debt outright. The narrative of taxpayer protection masks a simpler truth. The system thrives on perpetual motion, and bankruptcy would pause it, so the legal armor stays intact. Servicers continue, generation to generation, insulated from the normal cycle of credit and risk. The industry calls it stability. Borrowers call it forever. And until that shield cracks, student debt isn't just hard to escape. It's structurally designed to outlive the people who carry it. Reform or rebranding, the industry's next phase. By 2025, borrowers logging into their loan accounts saw a different set of names on their screens. MOHELA, Advantage, and a handful of smaller lenders branded with bright colors and fresher fonts. Press releases promised a new era of transparency and borrower-first service. For many, that felt like déjà vu. Navient had said nearly the same thing a decade earlier. The supposed new phase of student loan servicing looked suspiciously like a rebranding campaign. At first, it worked. Borrowers received letters with reassuring phrases. Welcome to your enhanced repayment experience. The sites offered cleaner dashboards, simplified drop-downs, and mobile notifications instead of paper mail. The goal was modern optics, to distance these servicers from the scandals of the old guard. Yet behind the interface, the same architecture powered it all. The databases, the contracts, even the call protocols were inherited whole. The maze had simply received a coat of new paint. Take Advantage, the company that took over Navient's federal portfolio in 2021. As part of Maximus, a government services contractor, it marketed itself as a reliable steward with a track record in federal administration. Borrowers hoped that meant fewer errors, less chaos. What they found instead were familiar frustrations: miscounted payments, delayed processing, and hold queues just as long. Slightly better branding didn't make the underlying business model any less opaque. MOHELA, another large servicer, was touted as the trustworthy successor, gaining new federal accounts in 2024 after lobbying successfully for expanded contracts. It positioned itself as borrower-friendly, with glossy outreach campaigns emphasizing community investment. Yet in 2025, it became one of the most complained about servicers on record, drawing scrutiny for the same issues that sank Navient: lost paperwork, confusing statements, and lack of communication about forgiveness eligibility. The new era looked a lot like the old one, only rephrased in marketing language. The government's 2024 performance-based contracts had been promoted as a fix for these repeating patterns. They attracted new bidders, promising higher payouts for positive borrower outcomes. But positive outcomes proved slippery in definition. Did it mean fewer defaults? Faster call resolution? Happier borrowers? Each servicer interpreted metrics differently, and oversight lagged. The supposed accountability reforms resembled the standardized testing of public education: easy to measure, hard to translate into real learning. In theory, the new contracts incorporated penalties for persistent borrower complaints. In practice, those penalties were modest, far less than the profit from holding millions of loans steady for another fiscal quarter. Servicers learned to adapt by tweaking how they reported customer satisfaction data, conducting proactive outreach surveys that emphasized positive responses. The numbers looked improved, the experiences didn't. The illusion of progress turned into a data product the Department of Education could present to Congress as proof of improvement. Borrowers, however, noticed the difference only in cosmetic ways. The SSL encryption icons glowed brighter, login pages loaded faster, mobile apps now offered balance charts. But beneath that polish, the counts toward forgiveness continued to fluctuate. Some logged in to find one forgiven loan replaced by a reinstated balance under review. Others were told their consolidation reset their IDR timeline, even though guidance had promised the opposite. When they asked for explanations, they received the same carefully automated replies about system updates. Policy analysts warned that reforms based on optics are inherently fragile. Without structural change to contract incentives, modernization becomes a form of public relations, borrower trust renewed not through improvement, but through amnesia. Once the fury over past mismanagement fades, rebranding reinforces the message. Maybe this time will be different. Borrowers re-engage, data refreshes, the cycle renews. Inside Washington, the next phase carried different language depending on the audience. To Congress, it was transparency. To contractors, it was expansion. The 2024 laws introducing accountability standards for servicers spoke loudly about enforcement, but offered no funding for it. Oversight requires personnel and technology, two things chronically undersupplied. That's how servicers thrive, by acknowledging regulation publicly while planning around its practical weakness privately. Borrower advocates saw the trap forming again. MOHELA and Advantage may not have inherited Navient's lawsuits, but they inherited its system. The call scripts, the performance dashboards, and the flat-fee payment model that rewards volume over accuracy. Whether labeled Maximus or MOHELA, the function remained identical: manage a high risk. Debt portfolio cheaply while appearing benevolent. Each rebrand emphasized values and support, but never disclosed earnings or internal metrics. Borrowers got empathy in email form while the machinery stayed untouched. The most revealing detail about this stage wasn't in the contracts themselves, but in the language of their press releases. Every communication emphasized continuity. Continuity of service, continuity of access, continuity of borrower support. The word sounded reassuring until you realized what it implied. No break in revenue, no disruption to the status quo. Even reform had to ensure business continuity above all else. A young borrower named Marcus noticed the pattern firsthand. His loans moved from Navient to Advantage to MOHELA in under 3 years. Each transfer came with a note saying, "No action required." Yet every portal listed a slightly different payment history. When he tried reconciling them to ensure his forgiveness credit remained intact, all three companies pointed to each other. Marcus joked online that he'd had more loan servicers than roommates. The comments filled with similar stories. The bureaucracy may have modernized its domain names, but not its accountability. The core question people began asking was simple: can this industry reform itself when profit depends on persistence? True transformation would mean changing incentive algorithms, not hiring branding consultants. It would require the Department of Education to regain direct control of servicing, or at least rebuild sufficient in-house oversight to keep contractors honest. Yet officials admit privately that dismantling these systems would risk technical failure for tens of millions of borrowers. The paradox is brutal, a system too flawed to trust, but too integrated to replace. There are genuine signs of progress. Automatic income data matching between IRS and education has reduced yearly paperwork for many borrowers. The department's creation of a centralized complaint portal has made cross-servicer tracking possible for the first time. These are real steps forward, but each advance still relies on the same contractors maintaining the databases, ensuring oversight filters through the very companies being overseen. One cracked mirror reflecting another. Politicians love declaring victory after incremental change. Press conferences celebrate record improvements and expanded forgiveness pathways. Yet those headlines mask how slow enforcement remains. For every borrower helped, others are caught in transitional errors or unaddressed appeals. Reform looks good on paper. In execution, it's just another relay in an endless race where the baton keeps changing hands. By late 2025, borrowers began remarking that the language of their emails felt eerily corporate, phrases like ongoing enhancement or user experience upgrade. Debt portfolios were being managed like software subscriptions, with periodic updates but no real closure. Servicers now acted less like billing departments and more like perpetual service providers, rebranding as financial wellness partners. The irony was rich. The companies originally accused of creating confusion were now marketing expertise in ending it. The final act of this new era hasn't been written yet. Optimists claim performance-based oversight will gradually push servicers toward genuine transparency. Cynics believe the contracts merely traded one layer of bureaucracy for another. Somewhere between those views lies reality, a revolving door of reform that functions less as correction and more as continuity plan. The open question remains: if making repayment simple would undermine the system's profitability, can the system ever fix itself? Each rebrand, each new phase, nods toward progress but preserves the engine beneath. Logos change, leadership changes, mission statements refresh. But for borrowers still logging in every month and seeing balances that barely move, the experience feels timeless. Modernized or not, the system endures, smiling a little wider behind every update, promising help while quietly ensuring the need for help never disappears. A debt trap factory. Standing back from decades of lawsuits, lobbying, and endless reforms, a single image emerges, a factory. Not the kind with assembly lines and smokestacks, but a digital one. Its raw material is confusion. Its product is time. And its output is profit earned from debt that never quite ends. Every component we've explored feeds this factory. The legal walls keep the borrowers locked in. The servicers, paid by contract, keep the process running. The politicians, courted through donations and policy memos, keep the framework intact. What binds them isn't conspiracy, it's convergence. Everyone benefits from duration. Every month your loan exists, it pays someone. That's the secret economics of permanence. Most borrowers think of repayment as a tunnel with an exit at the end. But in practice, it's a loop. Payments go in, interest reshapes the balance, errors reset timelines, and new programs shift qualifications. The years pass, but the system remains at equilibrium, a design that ensures depletion never arrives. Imagine a factory floor diagram, each station labeled: originate, service, transfer, recalculate, collect. Every federal contract is another gear in that assembly. The borrower is the conveyor belt moving through, document after document, form after form. At each stop, a fee gets logged, a report gets filed, and a piece of the debt gets polished, rebranded, reorganized, but never destroyed. You can see how every reform merely adjusts the machinery. When one practice draws scrutiny, the factory replaces a part, rebrands a department, updates a script. The outward look changes faster than the throughput. Complexity isn't an accident of bureaucracy, it's lubrication. It keeps the system sliding past inspection, too intricate to pinpoint accountability. People like to assign villains: Navient, MOHELA, the Department of Education. But the truth is more systemic. The factory has no single operator. It runs on contracts renewed automatically and code maintained by teams who've inherited decisions from predecessors long gone. It continues because no one person can stop it without halting the payment of 40 million loans. Ending it would crash something bigger than a spreadsheet. It would interrupt the government's own cash flow. So it hums on, perpetual motion disguised as public service. That motion feeds on borrowers' attention. The system doesn't steal in dollars alone, it steals time. Every hour spent on hold, every afternoon off work to fix a form, every night lost to anxiety. Borrowers live inside endless microtransactions of attention. Servicers record those moments as interaction metrics. Policymakers cite them as engagement data. The debt factory measures your frustration and translates it into performance statistics. In that calculus, your stress is a usable output. To see how embedded it is, look at how debt behaves in old age. Seniors making payments out of Social Security checks, decades after graduation, still fall neatly inside the database categories: active repayment, offset in progress. As long as the label says active, the account remains valuable. Death is the only true closing event, but even then, closure generates its own fees. Estate processing, documentation, debt write-off filings, it's all billable motion inside the machine. What makes this structure so durable is its mimicry of stability. Everything looks orderly. Monthly statements arrive. Websites update. Politicians hold hearings. That regularity masks the churn beneath. Millions of micro-errors correct themselves statistically through volume, hiding heartbreak 1 percentile at a time. Oversight committees declare success because catastrophe never appears loud enough. And that quiet, measured continuity keeps funding secure year after year. For an individual borrower, the experience feels personal, every glitch happening directly to you. But on the industry's scale, those glitches are normalized loss rates, precisely forecast in contract budgets. The chaos that ruins your month is someone else's expected percentage. The spreadsheet already accounted for it. When you connect all these pieces, the moral language around responsibility collapses. It's not that borrowers are irresponsible. It's that responsibility was outsourced, monetized, and then fed back as moral instruction. The factory machine lectures its own product. You should manage this better. Meanwhile, the gears turn smooth as ever. Even forgiveness, the supposed endpoint, is built to recycle demand. Each mass cancellation wave requires fresh verification, new servicer transfers, follow-up audits. Relief creates work orders. Work orders create revenue. In the logic of this factory, even mercy is billable. What's left behind are the people. The teachers, nurses, analysts, parents, the countless individuals who believed in education as a ladder. They aren't lazy or entitled. They're participants in an economic model that thrives on permanence. They pay faithfully while the promised freedom drifts farther each year, like a moving finish line. After decades embedded in this structure, even policymakers begin to echo its language. They talk about sustainable repayment environments. They mean exactly what it sounds like: repayment that sustains itself indefinitely. The success metric isn't freedom, it's containment without collapse. Borrowers know this intuitively. They feel it every time a new plan launches with fanfare, only to dissolve into technical delays. They see it when simplification adds a new form. They sense it when customer service treats exhaustion as compliance. That's the emotional architecture of the debt trap, keeping you too tired to imagine alternatives, too entangled to quit. And yet, within that exhaustion, there's a fragile solidarity. Online forums turn into archives of resistance, people comparing notes, teaching each other shortcuts, decoding the bureaucratic runes. Each shared workaround tears a tiny hole in the factory wall. It doesn't dismantle the machine, but it shows that its power relies on obscurity. Visibility is the first malfunction. Step back again and the pattern is unmistakable. Legal permanence ensures every loan survives. Contractual incentives ensure every dollar lingers. Bureaucratic design ensures confusion persists. Together they form a perpetual circuit where debt equates to security, for everyone except the debtor. You don't need a grand theory to explain why balances barely move. The factory runs exactly as designed: slow, predictable, profitable. The tragedy is how familiar it feels. After years of promises that higher education equals freedom, millions now understand that debt itself became the industry's degree. Evidence of mastery in monetizing confusion. There's a bitter symmetry in how it ends. Borrowers entered the system believing knowledge would grant autonomy. Instead, they became data points sustaining an ecosystem that teaches a different lesson. That transparency without accountability breeds eternal obligation. So when someone asks why their balance hasn't budged despite years of payments, the honest answer isn't the system failed you. It's the system succeeded. It was built to manage debt efficiently, to keep it alive, orderly, and endlessly serviceable. The factory works perfectly. Its only defect is moral. That's the hidden curriculum of modern finance. Complexity as control, confusion as commerce. Borrowers don't just owe money, they owe attention, paperwork, patience. And until clarity itself becomes profitable, the machine will keep running, quietly, automatically, feeding on the hope that someday persistence will equal progress. The machine keeps humming. Every reform comes wrapped in fresh acronyms. Every outrage met with calm explanations about system upgrades. But underneath all the language, nothing essential moves. The student loan system survives by mastering confusion, by making the ordinary act of repayment feel like deciphering code. When people finally stop questioning the math, it declares victory. The truth running through every chapter of this story is simple. The system was never designed for resolution. It was designed for continuity. Servicers collect their flat fee, regulators file their reports, lobbyists adjust the rules, and the gears rotate onward. Each loan becomes a perpetual motion device disguised as progress. Borrowers chase clarity the way miners chase daylight at the end of a tunnel that loops back on itself, an emotional treadmill engineered to feel like forward motion while taking you nowhere. That cycle doesn't just drain money, it steals years. Hours on hold turn into weeks of waiting, which stretch into decades of payments that barely touch the balance. Time becomes the most expensive currency no one tracks. Yet the cost is obvious in quieter ways. Opportunities delayed, families postponed, dreams rewritten around monthly statements that never vanish. The irony is that the system's defenders keep using words like sustainability and efficiency. Those sound admirable until you realize that in this context, sustainability means endless repayment, an economy feeding on perpetual obligation. It's a design so normalized that even those inside it speak of repayment as permanent rhythm, not finite process. But if confusion built this world, clarity is the first crack in its walls. Understanding who profits from delay and how incentives align around obstruction strips away the illusion of personal failure. The borrowers weren't the problem, they were the product. Seeing that doesn't erase the debt, but it does dismantle the shame that keeps people silent. And once shame dissolves, accountability has somewhere to stand. There's no easy exit ramp from a structure this vast. Policy tweaks may help, enforcement may tighten, names will keep changing. But real change begins when borrowers stop mistaking complexity for inevitability, when they recognize that opacity itself is a business model. Systems built for confusion can't survive transparency. Every story told, every document shared, every collective demand for proof widens the fracture. The education system promised upward mobility. The servicing system turned it into circular motion. Yet history shows that even entrenched machines eventually break when their logic becomes undeniable. The first step isn't new legislation. It's refusing to play by invisible rules. Keep records, share information, ask impossible questions until they sound ordinary. Bureaucracy feeds on isolation, awareness starves it. That's the unglamorous path to freedom. Not a magical cancellation headline, but a slow reclaiming of clarity. When enough people see the pattern loses power. Every shared realization turns isolation into solidarity, every story told as a spark that lights up the dark factory floor. Every moment of understanding shortens the lifespan of confusion's profitability. The system depends on you believing it's too complex to touch. The truth is that complex is just another word for profitable, and awareness is the only thing it can't monetize. What happens next is still being written. In the end, the factory doesn't collapse with a bang. It erodes as people stop accepting its logic. Debt built on bewilderment can't outlast awareness. Every dollar repaid may not move the balance, but every truth uncovered chips away at the walls. Keep watching, keep questioning, and don't let silence reset the cycle. If you want to see where accountability might finally crack this machine, and how ordinary borrowers are forcing transparency onto the institutions that built their confusion, watch the next investigation. Subscribe, stay alert, and keep the signal alive.